Hi, this is the fifth complete comprehensive example. Now we will deal with the situation where the firm is following the fixed capital method and not the fluctuating capital method. Now when the fixed capital method is being followed, the entry for capital brought in by the incoming partner will be done through the capital account of the partner, whereas all the other entries, be it revaluation loss or gain, distribution of reserves, profits and losses of fictitious assets, treatment of goodwill, etc., will all be done through the partner's current accounts. So let's see how we will do that using this sum as an example. Let's go to the example sum. Example sum. A and B are partners in a firm sharing profits and losses in the ratio of 3:2. The balance sheet as at 31st March 2019 was. The balance sheet is given to the left of the screen. Additional information on the right of the screen. C is admitted as a new partner on 1st April 2019 on the following terms. First point, provision for doubtful debts are to be maintained at 5% on debtors. Second, an outstanding bill for repairs of rupees 25,000 is to be accounted in the books. Third, an unaccounted interest accrued of rupees 7,500 be provided for. Fourth point, A takes the investments at an agreed value of rupees 30,000. Fifth point, expenses on revaluation of rupees 5,000 are paid by A. Sixth point, stock is revalued at rupees 79,000. Seventh, the new profit sharing ratio of partners will be 4:3:2. Eighth point, C will bring in 1 lakh as his capital. Ninth point, C is to pay an amount equal to his share in the firm's goodwill, valued at twice the average profits of the last 3 years ended 31st March 2019, 2018 and 2017, which was rupees 1,50,000, rupees 1,30,000 and rupees 1,25,000 respectively. And the final point, half the amount of goodwill is to be withdrawn by partner A and partner B. We are asked to prepare the revaluation account, the partner's capital and the current accounts and the balance sheet of the new firm. So we need to note a few points here. In the balance sheet that is given, the capital accounts of A and B are given as 3 lakh rupees and 1,50,000 rupees. And there is also given current account balances for A and B. So this will tell us that the fixed capital method is being followed. So as I said earlier, the entry for the incoming partner C bringing in his capital of rupees 1 lakh, that we will do through the partner's capital accounts. All other entries for evaluation, gain or loss, or distribution of reserves, writing of goodwill, or treatment of premium for goodwill will be done through the partner's current account. As far as the treatment for goodwill is concerned, C is bringing in his share of premium for goodwill in cash, and half of the amount of goodwill is withdrawn by the sacrificing partners A and B. So let's begin with the solution. Solution. Revaluation account. Left side debit side and right side credit side. Particulars. Rupees. Particulars. Rupees. We'll go to the first point. It says the provision for doubtful debts is to be maintained at 5% on the debtors. The debtors amount is given as 1 lakh rupees. 5% on that will amount to rupees 5,000. We have an existing provision for bad and doubtful debts of rupees 4,000. So the amount which we need to create further is rupees 1,000. I will debit that amount to the revaluation account. 2. Provision for doubtful debts. 1,000 rupees. The second point, an outstanding bill for repairs rupees 25,000 to be accounted in the books. Unrecorded liability. 2. Outstanding bill for repairs account 25,000 rupees. Third point, an unaccounted interest accrued of rupees 7,500 be provided for. Interest accrued is an asset, bringing an asset into existence. So by accrued interest account 7,500 rupees. The fourth point, A takes the investments at an agreed value of 30,000. So the investment which is given in the balance sheet, it's showing at 40,000, but now it's going to be valued at 30,000 and then taken by A. In the revaluation account, we'll reduce the value of investments by 10,000 rupees. So to investments account, 10,000 rupees. The fifth point, expenses on revaluation of rupees 5,000 are paid by A. Now the journal entry for expenses on revaluation or reconstitution depends on who's bearing it and who has actually paid it. Now in this case, it's given in the problem that partner A has paid the expense. There is no information as to who has to bear the expense. So we assume that the firm bears it. The journal entry for expense which is borne by the firm but paid by the partner is revaluation account debit to A's current account, 5,000 rupees. Sixth point, stock is revalued at rupees 79,000. Book value of stock given in the balance sheet 74,000 rupees. There's an increase in asset of 5,000 rupees. So by stock account 5,000 rupees. The seventh point will not affect the revaluation account. Eighth point is about the capital brought in. The ninth point is about the firm's goodwill. And 10th point also will not affect the revaluation account. So let's balance the revaluation account. The total of the debit side is 41,000 rupees. And the total of the credit side is 12,500 rupees. So we are left with a loss on revaluation. Greater total 41,000 rupees. By loss on revaluation transferred to partners' current accounts. We have A and B. The total loss on revaluation is 41,000 minus 12,500, which is 28,500 rupees. The OPSR is 3:2. $17,100 against A and $11,400 against B's current account. So this is a revaluation account which has been prepared by us. Next, let's go and prepare the partners' capital accounts. Partners' capital accounts. Left side debit side and right side credit side. We have particulars, partner A, partner B and partner C. And on the credit side again, particulars, partner A, partner B and partner C. We'll bring down the balance of capital accounts of A and B by balance brought down. 3 lakh rupees in the case of A and 1,50,000 rupees in the case of B. Now the amount which is brought in as capital by the incoming partner C, rupees 1 lakh, we will do it through the partner's capital account. So it's by bank account 1 lakh rupees under C. No other entry. We'll balance the partner's capital accounts. To balance carried down. Total for A, 3 lakh rupees. Balance carried down is also rupees 3 lakh. Total for B, 1,50,000 rupees. And the balance carried down for B is also 1,50,000 rupees. Total for partner C, rupees 1 lakh. Balance carried down for partner C is also rupees 1 lakh. So we've prepared the partners' capital accounts. Next, let's go and prepare the partners' current accounts. Partners' current accounts. Left side debit side and right side credit side. We have particulars, partner A, partner B and partner C. And again on the credit side, particulars, partner A, partner B and partner C. We'll begin by bringing down the balance of the current accounts of A and B by balance brought down. 50,000 in the case of A and 10,000 rupees in the case of B. We'll bring down the loss on revaluation to revaluation account. As per the revaluation account, it's 17,100 for partner A and 11,400 for partner B. 17,100 for partner A and 11,400 for partner B. Next, we will deal with the reserves. General reserve appearing in the balance sheet, rupees 60,000. We'll distribute the general reserve by general reserve account. 60,000 rupees in old profit sharing ratio 3:2. 36,000 for A and 24,000 rupees for partner B. we'll deal with the goodwill. There's an existing goodwill of rupees 50,000 in the asset side of the balance sheet. It needs to be written off among A and B in their OPSR. So to goodwill account, 30,000 under A and 20,000 rupees under partner B. Let's go ahead to the working notes and calculate the value of goodwill of the firm. Working note 1, calculation of firm's goodwill. Average profits is equal to 1,50,000 rupees plus 1,30,000 rupees plus 1,25,000 rupees divided by 3, simple average, and we get 4,05,000 rupees divided by 3. Answer for this is rupees 1,35,000 rupees. Therefore, goodwill of firm is equal to twice the average profit of the last 3 years. So it's 2 into rupees 1,35,000, which is equal to rupees 2,70,000 rupees. C is goodwill. ₹2,70,000 rupees, which is the firm's goodwill, multiplied by C share in profits, which is 2 divided by 9. 60,000 rupees is C's goodwill. Working note 2, calculation of gain or sacrifice of each partner. We have the OPSR, which is given between A and B as 3:2, and the new profit sharing ratio between A, B and C is equal to 4:3:2. For partner A, old share 3 divided by 5 minus the new share 4 divided by 9. We get a positive 7 divided by 45, and he has sacrificed. For B, old share 2 divided by 5 minus the new share 3 divided by 9. We have a positive 3 divided by 45. B has also sacrificed. Therefore, the sacrificing ratio between A and B is equal to 7 divided by 45 is to 3 divided by 45 equals 7:3. So C share of goodwill needs to be divided, rupees 60,000 needs to be divided between A and B in 7:3, which comes to 42,000 rupees for the case of A and rupees 18,000 in the case of B. So let's enter this in the partners' current accounts. By premium for goodwill. $42,000 against partner A and 18,000 rupees against partner B. Now the 10th point tells us that half of the amount of goodwill is withdrawn. So let's withdraw half the premium of goodwill to bank account. 21,000 against partner A and 9,000 rupees against partner B. The 4th point, where A takes the investments at an agreed value of rupees 30,000. So investments has a debit balance. When A takes it over, we need to credit the amount of investments. So it's A's current account debit to investments account. $30,000 investments taken over by partner A. And finally, the 5th point, expenses on revaluation of rupees 5,000 are paid by A. So it was revaluation account debit to A's current account. So we have for the expenses on revaluation, by revaluation account for the expenses, rupees 5,000 against partner A. We've completed the partners' capital current accounts. We'll balance this. For partner A, credit side total 1,33,000. The debit side total 98,100 rupees. The greater total on both sides 1,33,000. To balance carried down. 1,33,000 minus 98,100 rupees. ₹34,900 balance carried down for A's current account. Total of B 52,000 on the credit side. The total of the debit side is 40,400. So it's 11,600. The balancing figure. There is no current account which is open for C. Now that you finish the current accounts, partners' current accounts, we'll go ahead to prepare the balance sheet. Balance sheet as at 1st April 2019. Liabilities rupees, assets rupees. We'll begin with the liability side items. Creditors, ₹75,000. There is no change in the value. The general reserve has been distributed, so it will not appear again. There's an outstanding bill for repairs. ₹25,000. Let's insert the capital account balances. Capital accounts A, B and C. Go across to the capital accounts. It's 3 lakh for A, rupees 1,50,000 for B and 1 lakh rupees for C. Three lakh against A, 1,50,000 against B and 1 lakh rupees against partner C. The total 5,50,000. We'll insert the current account balances also. Current accounts was there only for partner A and partner B. We have 34,900 rupees for partner A and 11,600 rupees for partner B. Total 46,500 is the total of the current accounts. Cash at bank, first item on the asset side. The opening balance of cash was 25,000 rupees. The capital which was brought in by C was rupees 1 lakh. The premium for goodwill, C share, rupees 60,000 was brought in by him, but half of the amount was withdrawn by A and B, so minus 30,000. So it's 1,55,000 is the bank balance. Debtors, original figure is rupees 1 lakh less provision for bad debts. It was 5% on debtors, so it's 5,000 rupees. Final figure of debtors 95,000 rupees. Stock has been revalued at 79,000 rupees. Investments has been taken over by partner A. The fixed assets tangible is 3,60,000 rupees. The third point in the additional information, there's an interest accrued amount of 7,500 rupees. So we've completed the balance sheet. We will remove the split and check if the balance sheet tallies. So this is the balance sheet which has been prepared by us. Total of the liability side 6,96,500. Total of the asset side is also 6,96,500. Both sides tally. We'll see all the accounts together. This is a revaluation account. It was prepared by us. Loss on revaluation. We had to transfer it to the partner's current accounts in this case. The partner's capital accounts and the partner's current accounts prepared by us. Capital accounts balance. For A it's rupees 3 lakh, for B 1,50,000 rupees, and for C 1 lakh rupees. Partner's current account balances. In the case of A 34,900 rupees and in the case of B 11,600 rupees. This is a balance sheet that was prepared by us. These were the working notes.